Hey, everybody, welcome in. Thank you all for being here. Happy Sunday. And I'm trying everything new today, so hopefully everything works. We have a new mic, new streaming software, new configuration of everything, and
everything works.
Hopefully it's not too loud. I have had complaints that it's too quiet. So here we go. And I'm a quiet talker anyway, so it doesn't make things better. A lot of stuff to go through today. Huge amount of material in a very short window of time. So let's jump in. I'm going to talk about the new FANG, when I believe the Fed will pivot, why I believe that's the case. You guys keep on asking these questions, where I come up with my data, what I look at. We'll look at some option strategies as well. We will talk about Mount Gox. We'll talk about the Lehman Brothers of 2022, what it looks like, what caused the contagion. We look at some Bitcoin ETH pairs and a whole lot more. So as usual, this is, let me blow it up big, this is edutainment, never financial advice. I share what I see, I share what I do, openly and transparently. That's it. First question is from Tiger Mark. We know Tesla, we're starting with stocks today, which is fun. We know Tesla, Google, etc. make up the majority of your holdings. Are you constantly looking for a new alpha to hedge? Ride the growth chain with Google, Amazon? Obviously more steady than rocket propelled. So good question. So just so the audience knows, I'm currently I got three bags, everything broken into thirds: real estate, equities, and crypto. And I'm about 80 to 82% Bitcoin and 80 to 82% Tesla in both those bags. It used to be 70%, but because other assets have come down more, these have gone up in proportion. So that's where I am right now. Now, your question, let's talk about, I think what we need to talk about is FANG. FANG was something that I traded in and out of way before people were even talking about it, like when Google was called Google instead of Alphabet, etc. But the important thing to know, just over the last 8 years, FANG stocks, which are part of the S&P 500, the market caps of those 5 companies make up 20% of the S&P 500, which is stunning. But not only that, over the last 8 years, they have brought in a 410% average returns versus the S&P at 100%. And it was up to 780% until the recent downturn. So that's important to look at and consider. Now, before we jump into what my other things I'm looking at, because this is a long-winded question. First of all, this is FANG, for anybody who doesn't know. Facebook, Amazon, Apple, Netflix, and Google. I added 3 X's to where I believe the growth is slowing down. And I was never a Facebook investor. I have held Apple in the past. I held Netflix very early on, more than a decade ago. I've always held Google, always held Amazon, but in and out of Amazon. That's kind of the way I look at these things. Now, there is a thing called New FANG. Some people always like to know what my music taste is. So for the music fans out there, I'll take 10 seconds to talk about this song, because I thought the New FANG, I came up with the New FANG. It's like, oh, I know a song called the New FANG from them Crooked Vultures, which is Josh Homme from Queens of Stone Age, John Paul Jones from Led Zeppelin, and Dave Grohl from the Foo Fighters, and Nirvana. This is my New FANG. This is MANTA. So this is Microsoft, Apple, Nvidia, Tesla, Google. These are the top companies that we believe will have the best, safest risk reward growth over the next 5 to 10 years. I currently hold Tesla, Google, Nvidia. I do not hold Microsoft or Apple. But what I do, getting back to your question, where I will play and what I did last year in other areas, I look at other names that are very fast growing and very oversold. So my MANTA Additions are things like Shopify, AMD, and Trade Desk. AMD I did not trade last year, but Shopify and Trade Desk I have heavily over the last 2 years. And also Bitcoin proxies, which includes names like MicroStrategy and some of the miners. That is all I look at. Remember as well, the key to success in the investment game is absolute focus. As soon as you start looking at more than 10 things, you can't be deep. And I work all day, every day, 7 days a week. So think about that, everybody. Less is more. Be very focused. But always keep your tap dancing shoes on, because things can change. You know, maybe Shopify has a problem. We need to get out of it. Maybe Tesla loses a key man. Who knows what else? Always be ready. And we'll talk more about other crypto assets too that could have issues down the line. So thank you for that great question. Next question is from Jailbird. Has a token release date been set up regarding the Mount Gox dump? And it's funny because we had two questions that were kind of similar but related, so we pooled them together. And related to that from Smoke and Joe, the ETH merge is timed to almost sync with the Mount Gox dump of 140,000 Bitcoin. Could we see the flippening? And what the flippening means is the market cap of Ethereum exceeding that of Bitcoin. So let's jump in and talk about the Mount Gox rehab plan. And this has been happening for a long time. So since 2014, I think the Mount Gox was founded in 2010. Back then it was extremely hard to buy Bitcoin. And they filed for bankruptcy in early 2014 after it lost hundreds of thousands of Bitcoin in a combination of theft, fraud, mismanagement. Sound familiar, ladies and gentlemen? Well, yes, we're right back here again. Now, it spent much of the years trying to reclaim some of the lost funds in order to reimburse creditors. And recently, it just announced, I think, the Mount Gox trustees would be liquidating holdings worth about 3.2 billion. And they break down to about 140,000 Bitcoin, 142,000 Bitcoin Cash, and 69 billion yen. And the yen has lost 30% of its value year to date. So that's kind of shrinking. Anyway, that's what fiat currency does. But the specific payout schedule wasn't outlined in the publicly available announcement, but we do expect it to happen in the coming months. So let's get back to the questions. So will it have an impact on Bitcoin price? First of all, we believe the Mount Gox users are the most hardcore of the hardcore Bitcoin maxis. These folks were in Bitcoin in 2010 to 2014, and you can't get much earlier than that. Also, you have to realize that Mount Gox isn't like the exchanges that we have today. It was the very first exchange, and it was super clunky to use and a very niche product. And also, there's very little information on Bitcoin back then compared to today. So we believe the people that actually get it back, this is the demographic that it's least likely to sell. They'll just be blessed and happy to have it back, considering how much they paid for it back in 2010 or 2011 or 2012. And so we'll see what happens. So we do not expect those 141,000 Bitcoin to be dumped on the market. Further, 141,000 Bitcoin represents about 9% of the daily exchange volume. While that is significant, it's still quite small in the grand scheme of things. And we saw exactly what happens when 80,000 Bitcoin hits the market recently as well. So it's not a big haircut. It's nothing to lose sleep over, considering what we've been through. And also, it's not like all the trustees has to sell Bitcoin in order to cover payouts of cash. They have the 69 billion in yen to cover those who want to be paid in cash, another 140K in Bitcoin Cash, whoever would want that, I don't know, to sell to cover anything that isn't planned. So from that perspective, not too concerned about the impact of price. Now, the next question is Ethereum Flippening. It said that the ETH merge timing is almost synced up to Mount Gox payout. Is that planned? Is it coincidence? Not sure, but it is kind of suspicious. And we believe, as we just covered, the Mount Gox payout isn't going to be much of a factor. And on the Ethereum side, who knows what's going to happen with the move to proof of stake, but we have seen a lot of price action. I covered that in yesterday's video. I think it was up 33% in 4 days. It's still holding strong. And but personally, let's look at the ETH Bitcoin pair. This is an important update here. So just so you see the action lately, this is over the past year. And the ETH to Bitcoin, you can see the ratio is currently at around 0.06 and change. And you can see where it has been. There's a couple of things to really notice here. One is the red line is the 50-day moving average. The blue line is a 200-day moving average. We are still very far below the 200-day moving average. But in terms of the 50-day moving average, it's the first time we were above it since, I think, approximately May. And now we are a good bit above it, and everything kind of mean reverts over time. But the point of this is, will it flippen? And for that to happen, net for me, by my rough calculations, Ethereum price has to go up by 2.5x, which would take us above $3,000, and Bitcoin has to stay stable for that flipping to happen. So the answer is no, highly, highly unlikely. Theoretically possible in the future, like 2 to 4 years from now, but still highly unlikely. So great questions. Next, go to crab cakes. What sort of impact can we expect, if any, due to the Solana lawsuit. So first of all, this is an unusual situation. It has everybody very, very much on edge. And of course, do your own research, decide what you want to be, and don't ever listen to anybody with any opinions on this. So it is a concern. The nature of this lawsuit does open a can of worms that we've been talking about repeatedly on this channel, and that is regulatory risk. Gary Gensler, SEC, have been going around saying everything outside of Bitcoin and Ethereum is an unregistered security, and the SEC is actively going after projects on that basis if they are unregistered securities. And given that Solana is much newer project compared to Bitcoin and Ethereum, it hasn't had the chance to become sufficiently decentralized yet in the eyes of the SEC to buck this classification or the Howey test. So this, from that perspective, this suit will inevitably bring in the SEC because only the SEC has the authority to make that call, not somebody who bought Solana at the top and is angry and is now going after Solana. So it is, from that perspective, in terms of my opinion, a little bit frivolous, but all is not lost. So a couple of key points here. There are some reasons for optimism. One is the SEC hasn't deemed Solana an unregistered security, and the Solana team will continue to make the case that it is not. And Solana can actually countersue the SEC and the US government, claiming that they have not taken the necessary steps to clarify the crypto regulation and are haphazardly applying judgment. Therefore, we need an umbrella regulatory framework for crypto. Basically, we need to have a law before we can pass judgment on who is violating it. Very important point there. And the third issue is there will be a grand settlement at some point, or else in these lawsuits will continue to pile up. And if, this is the most important thing I've been saying for quite some while as well, is if Solana can be sued based on these claims, then every single altcoin in the space can be sued as well. I think BNB, Avalanche, Cardano, Dogecoin, you name it. Everything out there is subject to this. So it's just going to go away. It's not, I'm not that concerned about it at all. So, but if you are, feel free to sell your Solana. And I think last time I checked, it was about $40. So it is 38.66. Fell down. It was at $40 yesterday. So that is the quick summary. And again, remember, this is not legal advice. We're not attorneys here, nor are we financial advisors. So next question from Macrodose. I hear Celsius being compared to the Lehman Brothers for crypto. If this is, if the bankruptcy announcement cites a liquidation of remaining digital assets, what could the possibility be, possible for that be? And would you buy in that moment? So this is a kind of a tricky one, but let's talk about the key point here, because there's a lot of other stuff that is kind of more difficult to respond to. One is you could argue from our perspective that the Lehman event was triggered by Three Arrows Capital, not Celsius. Celsius, we'll talk more, is probably more like an Enron, which we'll go through a little bit of history in a second. But here you see the whole history of how Genesis was owned by Digital Currency Group, which is parent of CoinDesk. Voyager lost a ton of money from 3AC. There's about 15,000 Bitcoin, et cetera, and a whole bunch of USDC. Then the fallout was also tucked down or impacted companies like Babel, Deribit, et cetera. And it's just that contagion cascaded and hit everybody hard. So that, I think, would be the better definition of the Lehman moment. But let's talk about the history of what's just happened. First of all, 3AC is the generation's Lehman Brothers, and Celsius is Enron, and we are living in extraordinary times, very similar to those of the past. I know it's very tough for us all right now, but if you put it into context, this is financial history. Not only did we have the worst first 6 months in the S&P 500 in 50 years, but also the contagion that's ripped through all things crypto. 3AC, Celsius, etc., the lies, the Ponzi, the tactics. Apparently the 3AC team have disappeared and escaped wherever they've gone to. They cannot be found. And being in this industry, I always categorize as the Wild West. And we've seen some ugly stuff happening. So, some movies, we could imagine there will be movies made about this time down the line in future. So a little bit of good news related to history, looking back at history. And typically, these signature bankruptcy events, contagion events, cascading liquidations happen close to the capitulation of the market. And what follows is the rebound. Are we in the rebound yet? I don't know. We're seeing lots of signs that are saying, yes, perhaps, but there might be another shoe to drop. We're not sure exactly. And the timeline of the great financial crisis during the early 2010s, triggered in 2008, 2009. As you can see, the Lehman bankruptcy was right at the capitulation. And not long after that, the market started to rebound. So that's a little glimmer of hope and history, the two H's. And here, again, we believe Enron, which happened closer to the dot-com bubble, is kind of more similar to the Celsius situation. In the late 1990s, the dot-com bubble was capped off with Enron collapse. You can see there in the chart. And Enron filing for bankruptcy also coincided with the market capitulation during the dot-com bubble. And hence, we're very close to the bottom. And remember as well, Mount Gox went bankrupt in 2014. And we were just talking about the rehabilitation funds. A lot of people are concerned about Celsius. Will it take 8 years for Celsius to unravel? No. Top attorneys that have looked at some materials believe it'll all be resolved sometime. People hopefully, maybe late, maybe early, but sometime around summer 2023 before people can expect to get some of their funds back. So again, that's just legal positioning that we read the other day. So next question, Airstyle. Why are the spot and future markets, e.g. Bitcoin USD and Bitcoin-perp, always synchronized? Even though it seems there is less activity on the spot market right now on FTX, for example, are exchanges manipulating the spot market based on future market activities? So great question. So first of all, this all goes back to why spot and futures are always synced. The future always moves towards the spot price as the delivery of contracts approach because of arbitrage, and arbitrage drives the market efficiency. And the way futures work is investors commit to buying, selling shares at a set point in price in the future, and this is formalized by a contract. And the key is this contract can be traded on the open market. And if the contract is higher than the spot, the arbitrageurs will short the futures contract by buying up the assets until they reach equilibrium. And if the price of the contract is lower than the spot, the arbitrageurs will long the futures contract and sell the spot asset to reach equilibrium. And exchanges don't need the prices for us to see this effect. The market does this automatically. And in fact, it does it now with these things. Bots do the arbitrage. So spot futures arbitrage bots are everywhere. We are now trading against bots and algos everywhere we go. So remember that. It used to be, back in the day, you'd be trading against a market maker or somebody in a big firm, but now we're trading against the machines. So you need to have very sharp tools to be able to do that effectively. Next question is from Clovar2. What do you watch to give signals that inflation is coming down and the Fed could pivot, e.g. oil prices dropping, 10-year bonds rising, etc., etc.? So this is a beast of a question, and I've touched on many different aspects of what I look at, but this will be a quick and dirty summary of all the things that I look at. I think there's 6 items. First, I look at core CPI, not CPI, but the core. Second, I look at the commodities, which kind of impact the full CPI and how far they are off the all-time highs and how high they were a year back in time, etc., to be able to judge if we are beyond peak inflation. And I do believe we are beyond peak inflation. We're just comparing June 2021 to June 2022, and that's a little bit unfair. So because of rear view looking. The third thing I look at is the 10-year. And remember, the 10-year Treasury bill is long-term inflation expectation. Currently, it's at 2.9%. But again, in this chart here, I have a couple of things. I have the 50-week. No, sorry. The blue is the 200-month moving average, and the red is the 50-month moving average. A 200-month moving average is a very hefty moving average. We are going back 40 years in this chart. This goes back to 84, so nearly 40 years. And you can see exactly what the 10-year has done. The overall trend is down and to the right. Okay. Now, the key thing about this chart is where I put the little blue arrow. We are above that 200-month moving average for the first time in 40 years. That means it's too high. Just math. The whole world is built on debt right now, and it cannot sustain this, my belief. So let's talk about GDP growth. This is the fourth element. I think I'm on 4. I look at, and this is the GDP growth or lack thereof. You can see here the Atlanta Fed keeps on re-estimating how bad the growth is. It's not positive, it's negative. It's been negative for the first quarter. It will be negative for the second quarter. And the question is, what happens next? Now, related to that is number 5. I think it's number 5 is the debt to GDP ratios. Very, very important. You've heard me talk about this a million times. Remember, 77% is the point of no return. You cannot grow your GDP your way out of debt. It is almost impossible, extremely difficult to do unless you do something like, develop cold fusion and have free energy for your economy and massive innovation like AI and autonomous vehicles. They could be things that could trigger an economy to do really well and expand growth, GDP growth, beyond the cost of paying off your debt, servicing your debt. But this chart here is a beautiful little chart. I think it's from something visualized. And it shows you everything here that is orange, all right, or red is dead or dying under the debt bubble. And that's it. No ifs, ands, or buts. And right in the middle, you see Japan at 257%. These numbers are like a couple months old. They're even higher now. The sixth thing I look at is my model. And note in the second to previous slide, GDP is going down. Okay. So the debt to GDP ratio will go up. It's again, just mathematics. That's all. Plus, the debt is growing every day. I look at the debt clock. It keeps going up. It's not going down. And GDP keeps going down. It's not going up. So it's only going to get worse. We'll be back above 130%, I reckon, in a quarter or two. Now, we have a system, as I mentioned, built on debt. There is, as I showed, the cycle of the last 40 years has resulted in lower and lower peak Fed funds rates before the market breaks. Okay, we are now outside of that curve before, and this typically happens before the money printer kicks in. And that's just what happens, is QE to infinity. And the last time, a little bit of history for you guys before I talk about this chart, is the last peak in 2018 was after the Fed's funds rate hit 2.25 to 2.5. So just remember that 2.5 number, before the markets plunged 25% in the fourth quarter. We are approaching that 2.75 Fed funds rate. That's above 2.5. That's above what broke the markets in 2018. And we have even more debt now. So again, I just look at history, I look at numbers, I look at mathematics, and this is why I have this GDP shrink factor here. The more they jack the rates, the more things go down. Finally, this is point number 7. This model was so good from ThHappyHawaiian. It's their Fed pivot model. I actually put it in my own trading view. And the average of the Fed funds model is the average of the Fed's funds rate. It's easy to build yourself in trading view. And the 5-year treasury yield by multiplying this by the combined rate by the national debt. And the chart is essentially a proxy for the acceleration rate of interest expense for the US government and has been a perfect indicator of Fed pivots for the last 30 years. Every time you see it bumping up there, this goes back to 82. That's the time frame that I pulled it for. And I added 2 blue lines showing kind of that cone. And the red arrow at the top is the first time we've exceeded this overall trend. Again, just like the 10-year I showed you before. This means we are on the cusp of going into a death spiral. And that is basically when increasingly large debt load with an ongoing deficit will only get exponentially larger as the interest expense increases. I'm going to repeat that again because it's too important to miss. We're built on debt, 130% debt to GDP. The deficit is getting worse. Okay, there's going to be no tax revenue in the US in 2022 from capital gains for obvious reasons, unless the market really rebounds towards the end of the year. And that only will drive an exponentially larger deficit as we go forward. And the more they increase the interest rates, the more they accelerate that debt spiral. Okay, these are the 7 things I look at with great frequency. And that's why I believe, a lot of people believe the Fed is going to continue hiking per this chart here. I have the estimates that are out there. Some people are calling for 100 basis points. That is for July 27th. That is the red line. And I put a red box around these numbers. Another 75 basis points on September 21st. Another 75 November 2nd. And another 75 December 14th. I can say if they do that, they will smash everything. That red box that I wrapped around those 2 extra hikes, that's as far as they go mathematically, unless they absolutely smash the credit markets. And that's just the model. So, Clavado, thank you for the question. Next question is from Google. What do you think will be the effect of the energy crisis in Europe on European miners and Bitcoin hash rate? And if Europe considers going back to coal, will this cause trouble for Bitcoin climate-wise? Great question. So one of the things, I kind of just dropped a whole bunch of thoughts here. So I did talk about the fourth industrial revolution, and crypto, blockchain, etc. will be a key part of that, and Bitcoin will be a key part of that too. That's why you got people like Jack from Square making huge investments in the space. Now, if they don't embrace this revolution, they will shrivel up and die. Second point is the ESG narrative is losing popularity fast. Look at what happened to Sri Lanka. Simple case in point. Third, regarding coal, I lived in Europe during the 70s, and I remember acid rain, and it was ugly. So going back to coal would be very, very scary. I think they need to start thinking about firing up those nuclear facilities again, but do it, of course, safely. Now, mining, per the Mining Council, is currently, Bitcoin mining that is, 56 to 58% renewable. And the reason is renewable energy is cheap energy, and miners go where the cheap energy is. So think hydroelectric power in Norway. So from that perspective, I think there is a lot of positive signs going forward, but it'll be renewable, it'll be cheap, it'll be stranded energy that can be sourced by these mobile nomads who are called Bitcoin miners. So from that perspective, I don't expect anybody in Europe to mine Bitcoin from coal burning at all. Now let's look at Europe in terms of the top countries right now. This is per Statista. Remember, the China data could be because the IP address hasn't changed. A lot of the Chinese miners are now in Kazakhstan, and they are putting a lot of pressure on the grid. We heard recently as well, Texas had to shut down some of the miners because of the heat of summer. People are running the AC, so the grid is under tremendous pressure. But in Europe, Ireland and Germany are the 2 main countries that matter right now. I don't know what type of power they're using, how much it is, but it's got to be renewable in some way or another. And I also know that Norway has some hydroelectric power mining as well. So I don't believe it's a big issue. I don't think it'll change that much or have a huge impact on how much mining is actually done. Going back to that chart, you will see the little green block at the top. I don't know what the breakdown is of that other, but it is approximately 12% of the total amount. And that could include a lot of other European countries. I also know in places like Iceland, they are doing a lot of mining as well using geothermal. So again, mining will follow the renewable energy. And that's why many believe the narrative needs to change, that mining, Bitcoin mining, is helping the energy revolution and indirectly helping ESG narrative because it's pushing the boundaries of what can be done cleanly and in an environmentally friendly way. So great question. Next question is from Rothbardian. You've mentioned you like straddles and strangles. Can you give examples and when you would use the defined risk variance? So I'm not really a straddle or a strangle guy. I have dabbled with them in the past, but just a quick reminder for everybody, a straddle is an option strategy that involves purchase of both put and call option for the same expiration date and strike price on the same underlying security. And the strategy is only profitable when the stock either rises or falls from the strike price by more than the total premium paid. So for me, straddles are a losing strategy. You need massive moves in the underlying asset to go either way before you even break even. So I don't like them at all. I'd rather make a guaranteed 12, 20% every 6 weeks doing a cover call strategy. Now, a strangle is also a popular strategy that involves holding both a call and a put on the same underlying asset. And a strangle covers investors who think an asset will move dramatically but are unsure of the direction. And a strangle is only profitable if, same thing, the underlying asset does swing very sharply in price. So I don't like either. What I like to do is simple, plain old covered calls. Sometimes I don't use equity. Sometimes I have leaps and I sell short-term calls against those. I sell naked puts to try buy equity cheap or on dips and volatile dips just to get some cash. And synthetic longs only at true market bottoms, but synthetic longs can be very, very dangerous in the event things go down. So I got into a synthetic long and on MicroStrategy, and it went from 300 to 200. So I had to exit it and reallocate it. So things can definitely go wrong. So make sure if you do any of this, not financial advice, but make sure you are at Pico bottoms, or else it's very dangerous. So that's what I do mostly. Next question is from Vine98. Your perspective on the need to reduce the number of crypto tokens. General consensus is that with 18,000 plus tokens, 99% are rubbish and need to be flushed, though there are still seems to be buyers for them. What event will need to happen for this to take place? So flushing 18,000 is really, really hard. And we've seen as well, people, despite these market conditions, they're still degenerating into garbage. Stuff that is just a meme or a Ponzi or whatever. People are still buying the stuff. It's very, very surprising. That's taken a lot of people by surprise. But the way we see it is the token half-life, typically most tokens live 4 years. They make it through one cycle, but they don't die. They simply shrivel up. Eventually, they lose liquidity and remain stagnant, and they never leave, or they just get delisted from exchanges. We've seen a lot of that happening lately as well. And after many of these tokens reach, say, for example, some reached all-time highs in 2021 during the peak of the bull, they will not return ever to those levels again. But sometimes people just hold. They have a hard time being ruthless and killing the weaker elements of their portfolio. Just hold in the hope that things will rebound. But it's always better to be on a faster horse. That's what I've always said. And sometimes you just got to get away. So this is kind of a little graphic from the Ishcoin graveyard. And it is kind of interesting. So thousands, many believe, are already dead. That's based on the cratering trade volume. Watch the volume very carefully on dead cryptos, just like watch daily active users on chains. Very, very important metric to look at. Also look at the social buzz. If people aren't talking about a crypto on social media, odds are it's also dead, because social media sometimes drives volume and trading. These two are kind of related. So I will not mention any names that I believe are dead for fear of retribution from people that hold them, but there's tons that are already dead. But they just take a long time to shrivel away. And we've seen stuff from 8 years ago that are still out there that have just gone nowhere but down. 5 years ago, tons of charts hit all-time highs 5-6 years ago, still are way, way off their all-time highs. So not hard to figure out. And the final piece is thank you, everybody, for all that you do. Super chats help support many programs. One is the ocean conservation programs and the protection of whales in our oceans. And Hammer is our third humpback whale we support on this channel. Previous ones are Howard and Sailor, named in honor of Mr. Howard and Mr. Michael Sailor. Hammer, the whale, was last seen in September 2021. And that's the exact same time Jeff Hammer joined our community. So, Jeff, we can't thank you enough for your time served as a veteran and your support of the channel. And as community members, we're inspired by your perpetual optimism and are honored to name this whale after you. So you now have a 30,000 kilogram or 65,000 pound namesake. Keep doing what you're doing, buddy. Much love. Thank you for everything. So let's jump to some questions. Hopefully they'll pop up. And no questions yet. Uh-oh. Hang on. I know they're coming. I have somebody bring them to me. There they are. Yes, just in time. So there's a team behind the curtain here. It's not just me. All right. So let's turn off our new hammer. It's amazing. So one Brighton. Would you learn a strategy to make money daily, like scalping or day trading? Is it worth learning? Yes, especially in these markets. So historically, I used to do that in the past, in the 90s. And then it became very stressful, very difficult to do with a day job. But if you have time, if you work from home and you can dedicate 1 hour a day, you can make it work. But remember, 85% of people lose unless they have the proper tools to make sure you are successful. Also, make sure it fits your lifestyle. You got to be very analytical. You got to have that process, and you got to be a machine when you do it, because you're up against other machines, algorithms and bots that I just discussed. So normally, I also didn't do it because I didn't want to incur short-term capital gains, because when I did that, I'd have to pay literally more than 50% back and it was kind of painful. So paying that level of short-term capital gains taxes. But this year I've got some losses I'm carrying, so that's why I am scalping and day trading quite aggressively. Forest Pump. Does your Tesla future price prediction of one share consider in the 1-to-3 split, or is it based on the current price of one share? It's based on the current price. It's too confusing to take that factor in, and that's the problem as well. When you look at prices, like if somebody pulls up an old video of, say, Cathie Wood talking about Tesla hitting $4,000 in the year 2024, it already hit that after they did the 5-for-1 stock split. So that was like a $750, $800 target. So years ago, she made that claim, and now she revises things. So it's very, very important to just talk about the current point in time and know exactly where the stock is going. And TradingView have a cool little feature where they show you exactly when the stock splits happened, and that can help you wrap your heads around everything as well. Jabba, how are you, buddy? Thoughts on DeFi chain? It's built on Bitcoin blockchain. We are actually, it's funny you should say that. We're doing an updated analysis of all the layer 2s on Bitcoin, including DeFi chain, and that is one that looks very, very promising. We're also looking at some of the Web 5 work that our friend Jack over at Square is doing, and some of the other names we looked at in the past. So they're still very early days yet, but for you, sir, yes, that's going to come hopefully within a week or so, an analysis of all these layer 2s on Bitcoin. Excellent question. We are not in a position to make a decision right now, though. There's lots of different moving parts. And again, these things are very early, and it's risky to get involved in early stage projects during this type of market. But that being said, some things are really rebounding very fast right now. Think Matic, it's Aave, etc. They've really come back fast. Artem, where would you be more secure to move funds from Coinbase, Trust Wallet or Phantom Wallet? And how could these platforms theoretically collapse? That's a tough one. It's very difficult to say. In full disclosure, I moved my Solana off of Coinbase for a number of different reasons, but I just wanted to put it to a better place. In the past, I used to stake with Phantom Wallet on things like, I think it was Everstake, and I shut that down because of the invasion of Ukraine, which I anticipated was going to happen, so I got out just in case it had an impact. Then I moved to Bison Trails. Bison Trails became another Coinbase company, Coinbase custody or something, so now I just pulled out of there. So I'm going to figure out what I do next. It might be a combination of wallets, but I'll let you know. I'm trying to also assess the risk of things like phantom wallets and online wallets, web wallets, hot wallets, whatever you want to call them. With all that's happened, I'm erring on the side of moving things towards just cold storage, just for safety for right now, until all the storm clouds pass, and then we can figure out the best places to stake stuff safely. But it's not worth that. As I always said from the beginning of the channel, asset protection first, alpha second. I'd rather not risk anything anymore and just have it safe and forego the staking rewards. So that's kind of my plan. But we will also be looking into potential risk from these wallets too. Great ideas for more videos we can do as well. Thank you, everybody. Fibonacci, could Bitcoin price be suppressed like gold via futures ETF? Would it prevent us from seeing a supply crunch as no actual Bitcoin is being traded? Yes, indeed. Just looking at the history of Bitcoin, every time a futures product was launched, either one, it marked the top, or two, it scalped a blow off the top. Kind of like what I discussed earlier regarding different assets and how futures contracts can actually take the volatility away from assets. It's one of the reasons they're there, is to remove risk from assets. And per the ARB slide that I mentioned, that is definitely happening. I do believe, though, you can't, I think a whole bunch of people describe it as holding a big, the air balloon, the volleyball, the ball underwater, beach ball is what I'm looking for, underwater for a long time. It's very difficult to do that. And the supply crunch is happening, especially when you look at the amount of Bitcoin being drained off exchanges right now. Everybody's moving to cold storage. The amount on exchanges is going less and less. And as that happens, literally the only way is up. It becomes a traditional supply and demand story. So I do believe there will be still a supply crunch because the futures ETFs can only label them so much. But one of the problems with gold is the paper gold sold multiple times over and over and over again. And I don't see that happening with Bitcoin because Bitcoin is also so much more transparent. You can see everything that's happening on chain. So the shenanigans that the gold industry and the JP Morgans of the world get away with, I don't believe can happen as freely because of the transparency of blockchain. My thought could be completely wrong. Crypto Poppy, is your conviction in Bitcoin and Sol strong enough to hold even if you're at a net loss? Yeah, this is not a time, Crypto Poppy, to sell. This is a time, if you can, if anybody can, is to reduce your cost basis. I'm still, I got to where my cash position needs to be. I still see a couple of clouds on the horizon, but I'm also now seeing more and more signs that we have actually bottomed, and more experts saying that we've bottomed too, like Mark Yusko. He believes that the Bitcoin bottom is definitely in. So from that perspective, my conviction in Bitcoin and so on is still very strong, but my conviction in other names is, you could argue, in full disclosure, even stronger. So the question is, like with my strategy, I can make a lot more money off things like leaps and selling calls against leaps on equities than I can from just buying and holding Bitcoin. And I don't use leveraged trading for Bitcoin because it's too risky with the volatility, but maybe it's something I will consider. And regarding Solana, regarding the law case we discussed at the beginning as well, that is a risk. Currently, because of the recent spike in Ethereum price, I literally only hold 3 cryptos right now. It's Bitcoin, Ethereum, and Solana. And my Ethereum position is about 3 times as large as my Sol position. So that's where we are. I still do, when I look at all the metrics, though, as I covered on Paul Barron's channel, you look at metrics, all of them, they give you the answer as to what is happening. But what we've also learned is chains can change very rapidly. Users can migrate to a better chain overnight. So again, keep your tap dancing shoes on. There's no saying where this industry will go, but that's the take for now. Bombiggy, just to all my friends, keep strong and we'll stick together. Family rules. You rule, sir. Thank you so much. And I hope you got back safe from your trip. And thank you as well for the super stickers. Doggone, Jeff Hammer, John W. Gula, Sir Winston, Rothbardian, Green Candle, Chadwick, and AC1. Appreciate you all, everybody. It was a longer one than normal. And KT, thank you. We got multiple KTs now in our community. So thank you, everybody, for being here. Happy Sunday. Let's have a very brief look at the market. Bitcoin's now hovering around that 21,000 level. It's just climbing up, ratcheting up. Ethereum has rebounded real nicely. A lot of excitement about proof of stake, and that will pull all the layer ones with it too. So could the bottom be in? A lot of people are still talking for, we're going to go to 12, 13,000. Wow, that's backup truck time if it ever happens. But there's just too little supply, too much demand right now. We'll see. But if another shoe drops, it could whack everything back down again. Or it could be a macro event. Or it could be the Fed sending us into financial Armageddon. Many different things can happen. We need to prepare for all scenarios. Keep some cash on the sides in case we get to levels where things are just impossible to ignore. So thank you all for being here. Let me see. This is new software. Have a happy weekend, everybody. Take care of yourselves and your families.